Welcome to the Intermarket Analysis video update. This is a weekly video that gives us a chance not only to look a little bit deeper inside of the S&P as far as earnings, it gives us a chance to look at other markets and then compare those markets to the S&P 500 to see if we're getting any insight as to what's actually happening. This is being prepared for Monday, March 24th. The areas that I'll cover in this video include valuation. That's where we look at the S&P itself, both on a historical as well as a forward-looking basis, comparing earnings with the current price. We also look at a pretty extensive study by using a variety of different charts of growth versus value. When the market's more positive and going up, growth outperforms value. When the market is under pressure or actually going down, value outperforms growth. We also want to keep an eye on inflation. There's a lot of fears about that right now. We'll see what is the market actually saying about inflation. We look at other markets outside of stocks altogether just to see how things are behaving right now. And that kind of ties into the inflation part of the video. Then I break it down and look at the 11 sectors that make up the S&P 500. We look at those individually and then compare them to the S&P. We also look at other indexes. This could be different stocks, different sectors within the stock market, just to get some insight. We look at correlations, different markets and how are they correlating with the S&P 500. And then we look at the long-term trends, very long-term. Finally, at the very end, I come up with a list of those things that are positive, and that's based on the 50-period moving average being above the 200-period moving average, and then a negative list, which means the 50-period moving average is underneath the 200-period moving average or in a downtrend. The first area is S&P 500 valuation. This looks at earnings that have already come out and then compares it with the S&P 500. And we have three levels that we're concerned about here. There's a ratio, and when we're at 10 or below, whether it's the S&P or another index, that is considered to be inexpensive or cheap. When we're between 11 and 19, or right in the middle at 15, the market is considered to be fairly valued at that point. And when we get above a PE ratio of 20, which is the red dashed line, then the market is considered to be expensive or even overvalued. Well, looking at this red dashed line, which is right around 4,000, well, we're closing in quite a bit above that at around between 5,500 and 5,600. So the S&P would have to drop all the way down to 4,000 on a historical basis look to be considered not expensive anymore and even drop below that. And you can see throughout most of history going back to 1980, that just hasn't happened. The market looks forward and it tends to be optimistic about what it sees, then going through some intense periods of pessimism. But right now, we're even with the declines that we've been seeing, we're still well above this red dash line. I break it out down here, price versus the red line. We have to get all the way back down to the blue line to be considered fairly valued, or even to get back below the 20 level. Then we also look at this in historical context going back to 1980. There's a 1987 crash. It seems really small now in comparison. And then you had the whole dot-com boom and bust and the housing crisis. That was the great financial crisis. And then how things recovered after that. Then here's the COVID plunge, which was a big deal at the time. Seems rather muted right now. And then we've been going up. Then we went into 2022, and then we've been going up ever since then. And we're seeing some weakness currently. Now, Robert Shiller came up with a variation of what I just talked about. Instead of just looking at earnings as they're released and compared to price, he smooths it out over a period of time called the Shiller PE ratio. And he's coming in right now at 35.28. Well, that's also well above that 10, 15, 20 scale. But to give it a little bit more context, we look at the median and the mean, which is between 16 and 17, and we're still pretty much almost double what we should be at as far as a valuation basis when looking backwards. This also takes a different bit of dynamics into account. This is that same chart, but it places some standard deviations above and below what the midpoint should be. And we've been above this one standard deviation for quite a while. And now this chart's a few weeks old. We've come down a little bit, but we're still well above this plus one standard deviation. This also uses standard deviations as well. And even with us coming down lately, we're still well above this yellow line. This looks at the US PE 10, that's the CAPE, the Shiller CAPE PE ratio, and then compares it with emerging markets and developed markets. And even looking across the world, the US is still has the most expensive stock market, but it's also considered to be the market that has the most value and the most potential to go up in friendly economic conditions. But the market doesn't do that. It looks forward. Everything I've showed you up to this point has been historical. The market looks out at what are analysts saying earnings are going to be? What are the forecasts? And then another PE ratio is calculated based on that. And the red line is what I pay attention to the most, and that is the forward-looking PE ratio for the S&P. And we're still just a little bit above 20, even with the declines that we've seen from about the middle of February. This pink line, this is the mega cap 8, and they're still in the 25 range, but they've really been coming down lately. And then down here, the blue line and the green line, these are the mid caps and the small caps. They're actually falling a bit under that 15 level. So one might think by just looking at this chart, oh yeah, mid caps and small caps, that's the place to be. Well, do they have the earnings to support that? Are we in an economic friendly environment that allows these smaller companies and even mid-sized companies to grow and then justify higher stock prices? That's why we see them really lagging behind currently. But the one that I focus on the most is the red line. That's the S&P 500. It's coming down, but it's still considered to be expensive. Now, part of what's been going on, especially since the election and then with President Trump coming into office, we've been seeing a lowering of the earnings estimates looking out into the future. They're still positive, but they're not as robust as they had been in the past. And that's part of the pressure that's happening. And it really amazes me that when we start to go down with the market, because we've been overvalued for a long time, and yet nobody seemed to talk about that. But when we start coming down, then I see all these charts and discussions about how the market's overvalued and it's due for a pullback. Well, we've been that way now for a long time. We just seem to be more focused on that when the market is actually going down. Then this also looks at the PE ratio, the forward-looking PE ratio. This is the Magnificent Seven. Of course, I just showed the Mega Cap 8. There's the Illustrious 11, whatever group you come up with. Now, it's really falling down, but we're still coming in at 25. We want to stick to that 10, 15, 20 scale. And even with the declines, it's still expensive. And then the rest of the stocks that make up the S&P, they're actually falling under 20 now because the PE ratio that I just showed you takes all of the stocks together. This breaks them out. Another chart, looking forward here. This puts some bands around here, standard deviation again. And we're really coming down to the lower end here. So this could end up being positive. We're getting close to that 20 level again, where we have 21 in about the middle. Could this be a chance for the market to actually bounce back up? Now, I don't use any of these charts to make decisions because, as I said, the market can be overvalued for a long time. Mid caps and small caps have been either fairly priced or undervalued for a long time. So I don't use it as any kind of a timing mechanism. This is more just for information to let us know how is the S&P looking, how are other indexes currently looking. Then we go through growth versus value. Now, first of all, I look at just a growth index. And you can see it's in an uptrend, but it, since about the middle to latter part of February, has just been coming down. Growth has been getting hit. We're underneath the 200-day moving average. We're trying to come back up, but right now the 200-day moving average is acting as resistance. It would be more positive if we could get back above this red line and then stay above the red line. We look at value, which is also in an uptrend, but it's not really doing all that great. It's just been kind of going along sideways. But where we get some insight is when we do ratios between the two. Growth versus value on top, seeing how growth has been pulling back. And then just because we might get some different insight by looking at this a little different way, this is an inverse of that same chart, value versus growth. Value had been underperforming, but lately has been outperforming as the market has been getting more defensive. And we don't know how long this is going to last. We're just seeing this right now. I watch it on a daily basis and I go through this in the daily videos. If we see any hint of a switch one way or the other, I always bring that up in the video. This video is only done weekly, and I take a little bit longer look and looking at different charts to try to get a bigger picture perspective. Now we look at a peer growth index versus the peer value index, where we've been pretty choppy here, but we're still in an uptrend, even though we're well underneath the 200-day moving average with this ratio. This is an inverse of that same basic thing where value's been underperforming, but lately popping back up. Another look with some ETFs showing value in an uptrend, but pulling back underneath the moving average. And then this is value versus growth, a little shorter term chart here. We're showing that value's been outperforming lately. About halfway through February is when all this really started to change. And then we look at another growth to value ratio here underneath the 200-day moving average. We're seeing the same basic things, whether we use ETFs, indexes, short-term charts, long-term charts. We're coming to the same conclusion with every chart that we look at. Then another one that's a little bit different here is we take a growth ETF and a value ETF and do a ratio. And then there's a rainbow plotted here where we've dropped below the rainbow and we've been trying to get back up here, but we haven't even been able to get back up to the bottom end of the rainbow, at least yet. This is that same thing, but inverted. Value has been underperforming, but lately been doing better. Now, value you can think of as like toilet paper and toothpaste, healthcare, things that people have to have, even if the economy starts to suffer. Where growth is Microsoft, Google, Apple, Nvidia, the stocks that are the real high flyers when we're really going to the upside. Okay, then we look at just the small caps. And we were doing pretty good here with the growth to value ratio, and then we fell down and we've been just chopping sideways. We're not really seeing any strength coming back in, but we're not seeing any more weakness. But we're still underneath the 200-day moving average with this as small caps have been coming down. We look at another ratio for the mid caps, actually coming back slightly above its 200-day moving average. A little bit of hope there. And we look at the S&P growth to value ratio, still well below its 200-day moving average. This had been doing quite well up until about mid-February, and then things started to really turn. What we're trying to figure out now is, have we fallen far enough and then the market can continue to go back up? Or are we just resting right now and kind of going back up a little bit before we get set to go down even lower? All right, looking at inflation. This is a monthly chart of the CRB index. These are commodities, and we are in an uptrend on a monthly basis. And then I look at inflationary areas versus deflationary areas, and we're still in a downtrend for now, well below this red line. This is suggesting on a long-term basis, inflation is not necessarily a problem. Then we look at the CRB index on a daily chart, and this is in an uptrend. In fact, commodities are now starting to outperform stocks. And that's a bit of a concern with this going up. It's been pressuring the stock market. We look at the Baltic Dry Index, another type of inflation gauge here, where it's in a downtrend, but it's really been coming up lately, and that could be inflationary. Then we look at inflation expectations, and this is an actual ETF that you can trade. Well, ever since the beginning of 2025, this has been going down. It's not going up like a lot of people are really afraid of, at least according to this. And there's smart people that follow this and trade in this. They think that inflation is actually coming down. Then some other markets that are commodities-based markets, like aluminum, it's in a downtrend. That's not inflationary. Corn is in an uptrend, but lately it's been pulling back here. That could be inflationary. Wheat still basically in a downtrend overall. We look at fertilizer, it really started to go back up, but now it's leveling off. But the higher prices could be inflationary. Lumber, this is in an uptrend, and this is inflationary. Oil, which is actually going down right now, we got back up into the 70s recently, and that was mainly for geopolitical reasons, and now it's been dropping back down. And we look at a gold to oil ratio. The reason this ratio is going up is because gold's going up and oil is going down. And then we look at the 10-year yield, which is in black, which has been coming down and now possibly starting to go back up. And then we look at oil, which has been coming down and possibly going back up. But the relationship or correlation between the two right now is neutral. We're below this blue line, we're above this red line. I consider this area no man's land or neutral if you'd rather have it that way. We look at gas, which is still in a downtrend, but been bouncing back up lately. It's kind of interesting. Leading up to the election, this was in a pretty solid downtrend. Once the election got over, we started going back up. And then heating oil, which is still in a downtrend, even though it bounced back up recently. And natural gas is in an uptrend. It was just getting hammered for the longest time. Now it's starting to go back up. And we look at diesel, which is actually going down currently. And then we look at copper. And the way I explain copper is it's used to build a lot of things, industrial products. And if companies were not willing to pay more for copper, that means that they're worried about the economy getting worse off into the future. So we look at copper because sometimes it tells us ahead of time, okay, what is the market anticipating the economy being like? And copper's just almost back to an all-time high here. And it's in a pretty solid uptrend. It's also in an uptrend on the weekly chart. So if this market was concerned about the economy, it would be going down, not up. So this is actually showing that there's some confidence going forward in the economy. We look at a copper to gold ratio, which lately copper's been bouncing back. Gold's been going up too, but copper's also been going up. This is longer term. We're coming back up here. This goes all the way back to 1980. And then just to give it some more context, there's the 2-year yield in green and the 10-year yield in red. We're seeing quite a wide spread between the copper to gold ratio and interest rates. Now, these are all on different scales. But we're wondering, is there a general shift that's been happening? But I've been talking about this now for a couple of years, 3 years, pretty much since the COVID crash, and then the bounce going into the end of 2021. This is what we've been seeing, and this ratio continues to go down. And we're just watching to see, are we switching as far as the overall long-term view of the economy changing? And we look at gold to silver ratio. When this is going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And then we compare it to the US dollar index, and there's a fairly high correlation. This just shows us the relationship between precious metals on top and currency in the bottom. And the correlation is pretty strong right now. We look at the closing price for gold and the closing price for silver, we can see that their correlation is pretty strong, getting a little bit weak lately. And that only stands to reason. I mean, silver and gold, silver and gold. I mean, the two just go together. So you would think that their prices would pretty much go together too. They get out of line with each other from time to time, but for the most part, they have a pretty strong correlation. Gold coming off of setting recent all-time highs. Silver doing really well, not at all-time highs, but pulling back recently. And then the dollar, which is still in an uptrend. This is a 50-period moving average above the 200, but a couple weeks back, it's just been getting hammered lately, and it's underneath its 200-day moving average as well. It was really going up. It liked the tariffs, and then about the halfway through February, it just started to crumble with the stock market. We look at the euro, which had been going down as the dollar was going up. Now the euro is going up as the dollar is going down. And we also plot the Japanese yen, which is just about ready to be in an uptrend against the dollar. Here, I break this out. The euro to the dollar, still in a downtrend, but well above the 200-day moving average. And the euro's been really outperforming the dollar recently. This is what I was talking about. We're just about ready to see a cross here with the Japanese yen actually in an uptrend compared to the US dollar. And then the British pound in a downtrend compared to the dollar, but really bouncing up lately. Then we look at some index ratios. This lately, because we've been not really seeing any real conviction in the stock market. This comes and goes out of the daily video, but we have the weighted version of the S&P, which is the bar chart, and that includes all the big stocks, and they account for most of the movement in the index. Well, then there's the equal weight version of the S&P, and that treats all 503 stocks the same. So Nvidia is counted just as much as the smallest company in the S&P. And they go more hand in hand with each other, and they're on different scales. But you notice back here, last fall, when we were seeing a really solid market and the red line was pretty much going up with the bar chart, that's a good solid market at that point. Then we started to see the S&P coming down, but the equal weight was going down more. Well, lately, we're seeing this shift over to value. And for the week, the equal weight S&P actually outperformed the S&P itself on a percentage basis from week to week. This is another way of looking at that. When we're going down with this ratio, that means the equal weight is underperforming the S&P. We've been trying to go back up, but it's been a little bit choppy here lately. And then we look at a ratio between stocks and commodities. You notice how we're seeing a downtrend right now? That means stocks are underperforming commodities. This is an inverse of that same chart, how commodities are now starting to outperform stocks. And the Nasdaq 100, which has not been doing well in 2025, and the S&P, which has not been doing well in 2025. Well, the Nasdaq 100 has even been doing worse. It's actually underperforming the S&P 500. It's going down more. The S&P has been holding up better because it is more balanced as a bigger index. The S&P 100 is underperforming the rest of the S&P 500. And in a solid environment, it's just the other way around. The Nasdaq, which had been a stronger part of the market, it's now underperforming the S&P, and the Nasdaq 100 is starting to outperform the Nasdaq. Now, both of them have been getting hit, but the Nasdaq 100 is now holding up better than the Nasdaq, which is a much bigger. It's the Nasdaq Composite, where this is the 100 biggest stocks that make up the Nasdaq. So this could end up being positive, but it depends on your perspective. Maybe it's because the Nasdaq is showing more weakness. Now, on the charts, when you look at these individually, they're both under pressure, but they've both been hanging in there fairly well. But they've been underperforming the S&P 500. And we look at mega cap. These are the stocks that everybody loves to own and talk about until they start going down. And we compare it with the S&P 500, showing how the mega caps are now underperforming. And the small caps, which continue to just not do well. They were supposed to have a Santa Claus rally, the January effect, March Madness, who knows, spring delight, whatever, but it's just not happening for the small caps. They just are not performing all that well. And this red line is the ratio between small caps and the S&P. The blue line is the S&P. They've both been going down lately, but small caps have just not been doing very well. Mega cap growth actually falling underneath its 200-day moving average. You can see this really solid uptrend from 2023 up to the middle of February. This is what the market is concerned about. We're seeing weakness in these parts of the market that had been leading us to the upside. Now, we could come back. We've seen weakness before, and we turned and went back up. But is something shifting that's a little longer term and that's a little more negative now than what we've seen in the past? It's a different environment than when we had these pullbacks before. There's a new administration, totally different way of trying to handle things in America. And the market's going through some gyrations trying to figure out what it wants to do. And the robotics and AI ETF underneath the rainbow. I mean, I've been playing a lot with Grok lately. I think it's great. It's connected to Twitter or X. It's a pretty, for what I need it for, it is just so awesome. I really like it. But you look at this ETF underneath the rainbow. But when you compare it to the tech sector, it's just kind of going sideways. That's because the tech sector has been under pressure too. And then another ETF, we want to keep an eye on this one because we've come down to the 200-day moving average with the AI tech ETF. And so far, this 200-day moving average has been holding. If we can bounce back up, that would, of course, be more positive. If we start to break below this, now we broke below before. This was the end of the world day last summer. But if we can keep going down instead of bouncing down and coming right back up, that's going to be more negative for the market. Semiconductors in a downtrend under weakness. This was the area that led us out of the bottom back in late 2022 going into 2023. Is this leading us into some more weakness as we get into more of 2025? The Dow Jones Composite Average, which takes the Dow, the transports, and utilities, in an uptrend, but below its 200-day moving average. Then we look at the advanced decline line, and this I do show in the daily videos. We're still holding up okay with the S&P. We're coming right back down to the moving average, but we're below the moving average with the NYSE common stock, the mid caps, and the small caps. And this looks at another way of looking at Dow theory. Instead of using the Dow, we use the S&P, under pressure. Instead of using the transports, we use the NASDAQ, under pressure. We look for divergences. Right now, they're pretty much converging with each other. And then we break that down by looking at the equal weight version of the S&P, which never did set an all-time high back in February. It set one back in 2024, but the all-time high, that was mainly driven by the mega caps. And now that they're under pressure, that's why we're having a difficult time for the S&P. Then the equal weight version of the QQQ is coming all the way back down to this previous all-time high, and it seems to be finding some support there. This line's been here for a long time. It just happened to bounce up off of that. Could that be the beginning of something positive? We don't know. We're just watching this for right now. The FANG index just kind of goes a little bit above, a little bit below its 200-day moving average. This is another mega cap type index. The Wilshire, a broad market measure, is still underneath its 200-day moving average, as is the total US stock ETF. This going up, that means the Dow is outperforming the transports. The transports are just not doing very good. You can see here, they've been under a lot of pressure. And when they do seem to hold up better, they're just kind of going sideways. And then this is the relationship between the transports and the S&P on a ratio basis. When this is going down, that means the transports are underperforming. And we're actually seeing a real deterioration, almost back down to neutral when we look at the relationship between the S&P and the Dow Transportation Index. Low volatility stocks. These are the ones that people get into. And I try to explain this, that if you're a money manager, you run a mutual fund or an ETF or some kind of a investment type group, and you tell the people that are investing with you, I will always be in the stock market 100% of the time. We'll have as little in cash as we can. We won't go into bonds. We won't go into other markets. We'll only be in the stock market. Well, when the market starts to look difficult, that's what they head to. Now, 2024 was a great year for the S&P, and this was in a really solid uptrend. But this still is holding up where we've been seeing more weakness in the general market. Where we get some insight is when we do a ratio. When this is going down, that means even though the low volatility ETF was in an uptrend in 2023 and 2024, it was underperforming the S&P. Now it's starting to outperform, and we're just getting ready to see a golden cross with this ratio. This is similar to what happened in 2022, and that was the bear market that we went through. Is that what's starting to happen here? That's an open-ended question. We look at traditional Dow theory, the Dow on top, the transports, which you can clearly see are underperforming here, and then the utilities, which are pretty much going sideways. We look at ARK. It's a very popular ETF. A lot of people are in it. It's been under pressure because it owns a lot of Tesla, and it can't even seem to get back up to its 200-day moving average. And then we look at world stocks and we take out the US stocks. They're doing great. World stocks are outperforming US stocks. And that's what we see when we do a ratio. You see how this is going down? This is the S&P underperforming the rest of the world right now, where for most of 2023 and into 2024, US stocks were really outperforming. Are we seeing an overall shift? Is this just a shift that's going to wear itself out and then turn and go back the other way? Or are we starting to see more weakness that could lead to some more declines for the S&P? Then here's a monthly chart, also looking on a global basis where this is really coming down to this long-term moving average. And we look at a momentum oscillator, it's rolling over too. So even longer term, on a monthly basis, we are seeing some weakness coming into the market. It can be repaired. We've seen this weakness before, and then we were able to bounce up out of it. Are we going to continue to go down here, or are we going to find some support and then turn and be able to go back up? That's why I do the videos every day, because you can see these incremental changes in these areas. And these charts that I'm showing you here, I look at them every day, and if they really start to tell us something, then I will bring them up in the daily videos. The NYC Composite, it's back basically the best looking index right now, and it's still down to its 200-day moving average. All stocks, which looks at US and international stocks, been taking a hit after really being in an uptrend. Micro caps, just about getting ready to see a death cross here. These are the smaller, these are even smaller than the small caps. Emerging markets, this is in an uptrend and actually holding up better. And some folks are seeing that and pulling their money out of the US market and going into these other markets that are in different parts of the world. The Nikkei just seems to conglomerate right around this previous all-time high that goes back to 1989. This is another barometer of the economy. We're seeing some weakness here. We're underneath the 50-day moving average with high leverage loans. These are very risky. We're still in an uptrend, though. We have pulled back before. If we continue to come down like we did in 2022, that's going to be negative. If we can bounce and go back up, that means that this was just some kind of a corrective phase that the market's going through before it resumes going up. And we look at the S&P on top, the home builders, and we're seeing that the correlation between the top chart and the middle chart is fairly strong right now. We look for divergences. We're not really seeing that right now. Bitcoin can't seem to stay above 100,000. It's dealing with its 200-day moving average. And then we're in a downtrend. This is a long-term oscillator. When we look at China, we're going down. Emerging markets, they're going down. But you see where it's turning up just a little bit? They're holding up better than the US markets right now. And then you have Europe, which is starting to go back into an uptrend. We're rolling over in Japan, and we're in a downtrend in the US. Then we look at some ratios, energy to tech. This is also showing that energy is bouncing back up compared to tech. And then we look at the tech sector, the interest rates. You see where we're starting to go in a downtrend here? That just happened at the beginning of February or so, and that's a concern. We want the tech sector to be outperforming. Now it's underperforming interest rates. And then we look at an inverse of that, how interest rates are now starting to outperform the tech sector. Growth, that's buy low, sell high, versus government bonds. Right now, government bonds have been more attractive. Growth stocks were really doing well. Lately, they've been really pulling back. And this is an intermarket analysis chart here, which going back to the beginning of 2025, gold has been performing the best, followed by bonds based on price. And then in third place, which is negative though, oil. Then we have the dollar. And now in last place are stocks. Semiconductors looking pretty weak here. This is the SMH semiconductor ETF. It's starting to go into a downtrend. Then this is also looking at that same ETF, but measuring it using a rainbow, trying to bounce back up. But you can see these lines are really starting to collapse right now. Another look at semiconductors is the Dow Jones Semiconductor Index, just getting ready to see a death cross here. And then we look at the semis to tech ratio, just chopping along sideways. Neither of them are doing quite well, so we're not seeing one really outperforming or underperforming the other. Discretionary to staples, really under pressure right now. Staples doing better when compared to discretionary. That's more of a defensive look. Gold has been going up as the S&P has been going down, so that's why this ratio is going up. And the dollar's been getting hit. Gold's been going up, so that's why this ratio is going up here. And then we look at bonds. This is just based on price, where it's holding up fairly well. And then we look at the total bond ETF. This is in an uptrend, and that's positive for price, which means interest rates are tending to go down. But when we look at the world bond index, this is still in a downtrend, even though it's really been bouncing back up. We keep going up like this, and it's going to turn into an uptrend based on price. And then a long-term monthly chart of a stock to bond ratio. When this is going up, that means stocks are outperforming. We're starting to see some weakness here. For the first time in quite a while, we're dropping below this blue line. This is another look at how bonds have been underperforming stocks. Now they're starting to go above the red line and beginning to outperform stocks. Is that going to continue? We've seen these things happen along the way. Does this mean a longer term shift or just a phase that the market's going through? And then we look at a daily chart of yields where we've been coming down, kind of leveling out here with some of these, but kind of starting to go back up. Then this is a weekly chart, and I've been focusing on the Japanese 10-year yield, but nobody seems to care about that right now. They have other things to freak out about. These are junk bonds, which are holding up fairly well. They're still above their 50-day moving average. And then corporate bonds, which started to go into a downtrend, but now they've been recovering lately. And we look at a stock to bond correlation, just barely coming out of the neutral zone here. And the corporate bonds, which again, we're starting to go into a downtrend, but showing a bit of a recovery. And then I include these in every video, even if they're not telling us anything. This is the Fibonacci study on the 10-year yield, and we're right in between these two blue lines, so we're not getting any insight there. We have been shifting to a higher interest rate environment, which is different than what we've been seeing going all the way back to 1980. And then we look at the 30-year with some Fibonacci retracement lines, not really getting any insight there. Then we look at stocks versus the 10-year yield. Stocks are beginning to underperform on a trending basis. Junk bonds still holding up fairly well here. And then we look at junk bonds versus government bonds. This is holding up for the most part. And we look at the volatility of bonds. That's the MOVE index on top. The volatility of stocks, that's the VIX in the middle. And we see there's a pretty high correlation on a volatility basis between the two. This is not measuring price. This is measuring the correlation of volatility. Then we do some ratios. The S&P 500 to short-term bonds below the rainbow. And you're going to hear that a lot here. A broad market measure, the S&P 1500 to short-term bonds below the rainbow. Broad market measure, further out bonds below the rainbow. And then this shows how bonds have been underperforming stocks, but not lately. They've been outperforming. The tech sector to 3 to 7-year bonds below the rainbow. Riskier bonds, junk bonds, the government bonds, conservative bonds, this has actually been holding up. We haven't dropped down below the rainbow, at least yet. And then the long-term price of bonds starting to see a little bit of a recovery here. Then we look at the relationship between the long-term bond and commodities, and it's actually starting to roll over as commodities have been outperforming on a longer-term basis. And just to keep an eye on things, the German 10-year yield. This had really been going up. The German market's one of the stronger markets now in the EU, and it's the biggest market in the EU. But as the DAX, which is their index, has been going up, the 10-year yield has also been going up. And I've been throwing out the possibility of, well, if Europe steps in to help Ukraine instead of the US, that's probably why these rates are going up. But then their stock market seems to like that as well. So both are going up right now. We look at different sectors. The material sector, which is in a downtrend all by itself. And even though the S&P has been doing bad, materials have been doing even worse. Communication, a growth area underneath its 50-day moving average and actually holding up quite well. It's been going down, but it's been going down less, which is keeping this ratio going up when compared to the S&P. Then energy, which it's been just chopping above and below these lines. You can't determine what kind of a trend it wants to be in. Longer term, it's been underperforming the S&P. Lately, it's been coming back, and that is more defensive. This is similar to what we saw at the end of 2021 when energy really started to take off and outperform stocks. But we're just watching this because there's a lot of things that we could hang on to for the S&P to suggest that it could still go up. Financial sector was really getting hammered. Now it's been making a comeback, and it's one of the better areas when compared to the S&P on a shorter term basis. Industrials coming down and dealing with its 200-day moving average and pretty much going sideways when compared to the S&P. The tech sector underneath its moving average, 200-day moving average. And if we stay down here, we might see a death cross. We saw a golden cross here in early 2023. Semiconductors led the way, and then the tech sector came in after that, and we saw a really nice up move here. If this crosses over negative, is that going to shift things more negative for the market? Then the tech sector to the S&P, they both have been doing pretty bad lately, so they're both going down here. And staples, which have been holding up quite well all by themselves, and they were underperforming the S&P. Now they're starting to outperform, but recently they've been pulling back. Is this a general shift? Are we going to go up with the S&P and see this ratio go down? That would be more positive. All right, and then real estate coming down, the 50 and the 200-day moving averages are very close to each other, but still in an uptrend. And it had been underperforming the S&P, but lately bouncing back up. This is considered more inflationary. And as interest rates were coming down, that helps real estate to go up. Utilities, just kind of chopping along sideways currently, but holding up a little bit better when we compare it to the S&P. Just seeing a recent golden cross here with this ratio, meaning that utilities are outperforming the S&P. And then I watch this too, where we're spiking up here and starting to come down. Quite often that can be positive for the S&P, but we've seen that before. We need to see more follow through with this actually going up instead of down. That means the S&P is outperforming. Healthcare, a defensive area, just dangling around between the 50 and 200-day moving averages. And healthcare underperforming, now starting to outperform. That's more defensive. Discretionary, which is more growth. And then we've been really down there. And it's still in an uptrend, but lately falling down quite a bit when compared to the S&P. Then we look at some correlations. Stocks to the dollar, neutral right now, not leaning one way or the other. S&P to oil, tending to go in the same basic direction, which lately has been down. Stocks to the 10-year yield, neutral. The tech sector to the 10-year yield, neutral. Stocks to the 2-year yield, shorter term, pretty much neutral, but a slight tendency to go in the same direction at the same time. Then some long-term charts. This is a monthly chart of the NYSE, still above this long-term moving average. This is a 12-month moving average, but we are rolling over with the momentum. It's not as strong as it was before. Daily chart, NYSE, we're coming down here with the NYSE record high percent index. When this is going up, that's positive. This just shows that even though the NYSE has been holding up better, it's been under pressure lately too. And then a monthly chart of the S&P on top, and then we're seeing longer term, the momentum starting to roll over. And then we look at the S&P on top again, and then a ratio between stocks and commodities, which is similar to what we saw before, but this is longer term. And we're rolling over here with this momentum oscillator. Then global stocks also seeing some weakness now. We were starting to go up with this other momentum oscillator, the KST, but now it's starting to roll over. And then at the end, I go through the positive things. When you look at growth and value all by themselves, copper in an uptrend, the dollar's still in an uptrend, but my goodness, it's really been underperforming the other major indexes or currencies in the world. The CRB index looking pretty solid. Gold and silver are in uptrends. The mega cap's still in uptrends. The FANG index, all these are under pressure lately, but they're still in longer term uptrends. ARK, the low volatility ETF, staples, Dow Jones Composite Average, bonds based on price, everything except world bonds. The tech sector, high leverage loans, the Dow, the NYSE and Wilshire, the NASDAQ and NASDAQ 100. Now we're possibly getting ready. We're starting to see a death cross here with the small caps, and the micro caps may start to cross over negative. We're close, but not quite as close here with the mid caps. And then all stocks, both US and international stocks, emerging markets. That's actually one of the better looking markets right now. And Bitcoin, which is in an uptrend, but it's down to its 200-day moving average. And then on the negative side, we've got the euro, the yen, and the British pound or the dollar. But if it stays the way things are now, that's going to turn to a death cross. Now, this is actually incorrect. The ETF is positive. No, the ETF is now turning negative. And the SOX index is now negative as well. World bonds based on price improving, but still in a downtrend. And then corporate bonds. They're just dancing around. It can't decide what it wants to do. Thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.